everybody. How are we all doing? I'm back. We're back for another day. Exciting. Morning, Forex, Danny, Evil, Jules. Say hello if you're here, because I have no idea how many people are in here. Yeah, good to know who's actually here, because sometimes I think I might be talking to myself. Morning, Harold. So if you're watching on replay, as usual, any questions, stick them in the comments below, and I will get around to those and answer them. Or Discord, if you're having trouble getting in Discord, if you click the... I just wanted to show you something, actually, quickly on the stream. So if you're a member, you've got this posts section in here. And there's instructions and stuff in here. So if you're having trouble getting into the Discord, if you go to posts, there's instructions on how to join and where to join the Discord channel there. So just wanted to cover that. So yeah, morning, Harold, Linus, Craig, how are we all doing? So today we are going to cover, I don't know if FTNet's here, if he's not, if he is. But yeah, we were talking about in the stream about brokers and doing a stream on brokers. I might do that because it is actually quite a valid point. In the UK at the moment, we've got access to 1 to 300, 1 to 500, 1 to 1,000 leverage brokers, not in the UK, but overseas, and they allow UK people in them. That could change at any moment. And if that happens, from my perspective as a position trader, it's going to become very difficult for me to trade. There are ways around it, but the main way around it is by setting up multiple accounts and with 1 to 30 leverage and only trading individual instruments in each account. So there are ways and means around it, but it might not be a bad idea to do a broker session, and just so that everybody fully understands how brokers work and what is going on behind the scenes in brokers, because they are your friend. They give you access to the market, but they're also your enemy in the fact that they are literally there to take every penny out of your account at any opportunity. Yeah, good example with what I did yesterday, what I did today with that trade that I got out of on Euro New Zealand. Yeah, so this is the sort of stuff they do. So I asked them for a break-even trade. That was my entry. My stop loss was here. It was below my entry. Yeah, I said, get me out at that level, and they got me out at that level. They took $137 out of my account. I didn't ask them to, but I've signed an agreement with them to say execute my trades for me at the price I request. If you can't get that price, get me the best price you possibly can. So they go, he wants that price, we'll give him that one, because that makes us 137, and that makes him $17 or whatever the TP was on it. Yeah, so it's good to understand these people are your enemy, but they are the only way to access the market. So you don't have a choice. And again, it's one of those things I talk about. I don't worry about spread, commission, and swap because I don't have a choice. They all charge it. Whether one charges that or that, it's very small, isn't it? Market execution, for me, is more important than everything else. Getting the trades on quickly and being able to use automation and all that sort of stuff. So morning, Linus, I need to review next month on a different account. I need to renew next month on a different account. I have to comment on my phone and can't join the Discord. Okay, yeah. I don't know how it works. If you've got a blue star next to your name and you're in this stream, it should link. When you go into Discord and link your Discord to your YouTube, it will go, what memberships has this guy got? And if you have any membership at all, it will come up and show you the YouTube member section. But if there's other ways that you do things that don't work that way, I don't know. I can't help with that bit. It's a Google job. Right, so today we are covering main candlestick patterns for reversals, identifying good trading levels when not to trade, and targets for exiting price action trades and why they work. So those are the next 3 sessions for today, tomorrow, and Friday. However, they may be quite short. They may be long. Depends how long they last. So if we're about 3/4 an hour in and I've done the session, fine. If we're about 15 minutes in and I've done the session, I'll go on to the next one. Yeah, and we'll try and fill the time up. We'll have some time for strategy development stuff. I didn't manage to get much done with Harold's thing yesterday, but I also want to look at that the Monday entry thing as well on stock indices. So I want to tag that onto the end. So I'll shut up now and get on with it. So main candlestick patterns for reversals. So yesterday we looked at what a candlestick is telling you and the 3 outcomes of a candlestick. So let me just get a clean chart. So every candlestick is telling you the story of what has happened in that candlestick. The buyers tried to buy, they didn't manage to get anywhere. The sellers tried to sell, they didn't manage to get anywhere. That is market indecision, that is market balance, equality, whatever you want to call it. But basically, at the end of the day, didn't go anywhere. We don't know where it's going next. It's not given us any clues really as to where it's going next, so we stay out. But you could also interpret that as a bearish candlestick because the bulls tried really hard and the bears certainly didn't let that through. They've also tried twice to get through this price point and failed. So that is actually a good signal candlestick. Price action is telling you it's a short, and it did work. Yeah. So that's what we covered yesterday, what price is telling you and how important these things are, the wicks. Yeah. Exhaustion, market can't move any further. So a candlestick pattern is more than one candlestick, basically. So all candlestick patterns are these things linked together. Simple as that. A single candlestick is telling you what happened over the period of X, whatever X is, hourly, 4 hourly, 30 minutes, 5 minutes, daily, weekly, whatever you want. 2 candlesticks is telling you what happened over X times 2. So if that's a daily candlestick, this is 2 days. Yeah. If the market has tried to do something and failed, and then it tries to do something and fails again, there's a high probability that the market isn't going to be able to do what it wants to do. Otherwise, it would have done it. So a candlestick pattern is a confirmation, and we touched on this yesterday, a confirmation of more than one candlestick telling you the same thing, or telling you something is happening as a combination. Yeah. So candlestick patterns come in various forms. Sorry, one sec. Linus, wanted to buy New Zealand dollar, US dollar, but the 4-hour candlestick looks cooked at the moment. So a good example. New Zealand dollar, US dollar, 4-hour, which is what we're on. You want to buy it, but it looks cooked. Well, yeah, I guess it's gone down. This candlestick is, the bulls are trying to get back, aren't they? This is what causes propulsion gaps. Yeah, there is an imbalance or an inefficiency, as most traders will call it. It's bearish. Yeah. But as I'm in a position trade, I am currently long. I have to remain long. I can't just go, actually, I'll short now. That's a hedge. And that will cause all sorts of trouble. But yeah, that's cooked. Yeah, you're right. But that candlestick is also not finished. Yeah, it looks cooked now. We covered this yesterday, didn't we? It looks cooked now. But this candlestick could also end like that, couldn't it? Bullish. Yeah. Wait till the candlestick closes. That's the difference between waiting for confirmation, which is candlestick close, or waiting or getting in during price action, assuming that the price action you're seeing will continue, which is not always the case. But yeah, so looking at the candlestick patterns, they come in 3 forms. One candlestick, well, actually, there's more than that, but 1 candlestick, 2 candlestick, and 3 candlestick patterns. Yeah. So the ones that are obvious, yeah. And I'm just going to cover the main reversal types of candlestick, because this is what we're really looking for most of the time. There are continuation patterns as well, which really are only useful to you if you're trend trading or potentially breakout trading. But the vast majority of people are mean reversion traders, and the reason we're mean reversion traders is because 80% of the time the market spends doing mean reversion. Yeah, so it's better to choose mean reversion as a strategy because that's what the market does most of the time. So I'm going to cover the main reversal candlestick patterns and why they work and what they're actually telling you, what's going on under the hood inside these patterns. So single candlestick patterns are obvious. Yeah. It's a shooting star or its brother, the hammer. Yeah. So this is an exhaustion pattern. So what's happening in this candle is the price has opened, the bulls have tried to rally the market, and they have been completely overwhelmed by sellers, meaning that the sellers have taken control. So it is a reversal in the fact that whatever price action came before this, and this is an important element where these appear, whatever came before this is likely over. And the reason we use shooting stars and hammers is because they need to appear at the top or the bottom of a run. Yeah. So if you see there you go, perfect. If you see a shooting star as price is coming down, all that means is price is just continuing to do what it does. Yeah. But so this in effect you could use as a continuation pattern. But if you see a shooting star or a hammer at the end of a run after price has been pushing in one direction, think high of day, high of week, high of some kind of rally that's been going on for X period of time, that is telling you that the move is likely over. Because if it wasn't over, this would be a bullish candlestick. Yeah. So shooting stars and hammers are single candlestick patterns, and they're probably the most used ones, and you'll see everybody on the internet talking about shooting stars and hammers. There's millions of indicators out there that will identify them for you, but there's many ways they can appear. This one here, for example, useless. Yeah. If this was at the bottom of a run and looked like that, that means that we've exhausted all the selling pressure. Think about how banks and institutions work. We add a load of volume in small parts until we run out. Yeah, we've run out. Now, the weight of orders has shifted long. The buyers have taken control because there's less sellers in the market. This is the candlestick that tells you that potentially we've now got 25 million long and we only got 20 million short. The weight of orders has shifted back in the opposite direction. Lovely long. So you basically jump in long on those. And you jump in short on these, but only if they appear here or here. Yeah, this shooting star forming here, useless. Yeah, it's not useless because it's confirming that one, isn't it? But that's basically the single patterns. There is not really much else as far as single candlestick pattern goes that really exist. You've got what's called a strong close candle, which basically has a tiny little wick or no wick either side and is green. So that is a massive bull candle, or it could be a massive bear candle. That's a strong close candle. That's a strong close candle. Yeah. So there are these candlesticks as well, which are single candles, but they are just basically telling you there's been a load of bull action. Yeah. So in my experience, the strong close candle often will get mean reverted. So although it's a bull candle, you'll quite often find they will come back. So think propulsion gaps. Yeah. When a propulsion gap is formed, it is typically a strong close candle. Yeah. You could say that that is a strong close candle, but why is it not a propulsion gap? Because we came back up and retested that low, which means that there's no propulsion gap formed. There's no imbalance. So typically when you see a strong close candle, a lot of the time you will find it will pull back on the next candlestick and then likely continue in that direction because we've had a strong close. There's a lot of bulls in the market. Yeah. So they can actually be used as bullish or bearish candlestick patterns, which gives you what? A 50-50 chance. Does that give you an edge? No. There's no edge in a 50-50, is there? So strong close candles, I don't really pay much attention to. But if it pulls back, so if I get a strong close candle, a perfect example is what we're just looking at, isn't it? New Zealand dollar, US dollar. There you go. What a great example. Strong close candle followed by a long wick. What's that telling me? There's a load of sellers entered the market, followed by a load of buyers trying to beat them back, and the sellers going, nah, we're short. That is a great 2-bar candlestick pattern. Yeah. So on their own, that could be either way. on its own, that is definitely just that, but only if it appears here. And that is only that if it appears here. If you see this anywhere else, ignore it. Unless before it is one of those. Yeah, if that follows that, as in that, it's a strong signal to go long or short, which is basically 2-bar patterns. Yeah, so remember we covered yesterday what a candlestick is telling you. It's only telling you what has happened in the last X period of time, 4 hours, hourly, daily, 5 minute, whatever the time frame you're looking at. A candlestick tells you what's happened in that time period. That time period has passed, it no longer exists, and it's got no bearing on the future. However, if you say the same thing happening over and over again, which is what we look for as traders, that gives you a confirmation. And 2-bar patterns is where it starts to get more interesting and more exciting. So a bullish or bearish engulfing. Yeah, the bull candle followed by a bear candle, which is bigger than the bull candle, is a reversal. Yeah, it means that the sellers have completely taken control of the market. Yeah, so there. A bull candle followed by a bear candle. Again, really, really good candlestick pattern, but only if they appear after a run. Yeah, these are reversal candlesticks, are patterns, are exhaustion. What we're looking for is the market to have pushed strong in one direction for a period of time, and then for the buy cycle the banks and institutions have entered to be coming to an end. The first clues we get are they can't go any further. Yeah, they try again, they can't go any further. Okay, so they've run out of steam, which means that either they are now going to take profit on that move, or they've been overwhelmed by bank orders in the opposite direction. So a 2x or 2 candlestick pattern is going to give you much more confirmation and power as to the probability of that working out for you. And again, any time frame, doesn't matter. So there's a perfect example of your bearish engulfing. Yeah, great candlestick pattern. It's also an indecision because it's an outside bar. So the bulls did actually make progress, but then the bears made progress. Now, if this low, as it is below there, creates a bearish engulfing, it's a go. If it doesn't create a bearish engulfing and it's inside that low or that body of that candle, it's a real indecision. We looked at indecision yesterday. So that candlestick pattern there is definitely saying I'm a short, because we've not only not able to make progress, we have made progress south, i.e. we've made a lower low, but it's an indecision candlestick because it's got a higher high and a lower low, but because the body is bigger than that one, it's a short. Yeah, so the bearish engulfing is a great candlestick pattern. Again, when the bearish engulfing appears in a sideways move, it's got a 50-50 shot. Yeah, but appearing at a high, very important. See why I'm sort of saying identifying good trading levels and when not to trade is kind of coming into this session, because it's the same thing. Yeah, candlestick patterns, what we call, it's known as PASR, price action, which is what we're covering today, at support and resistance. Yeah, so if this is a resistance level, which it is, price is pushed up, couldn't get through, 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 price action at resistance. Yeah, this is what we're covering basically. So so basically that is a good candlestick pattern, bearish and bullish engulfings, but use them at levels that make sense. So I'm just going to try and find a good example. There we go. There's loads of examples. You'll find hundreds of examples of these that don't work, because if you think about what an accumulation is, yeah, a range. A range is price moving up and down constantly. What are you going to get as price moves up and down? Large volumes of buyers, large volumes of sellers, large volumes of buyers, large volumes of sellers. You're going to get bullish engulfings, followed by bearish engulfings, followed by, that's not a bullish engulfing, but followed by the same thing. Yeah, so there's a, let me get my head out. Let's just move the chart along a bit. Yeah, bearish engulfing, bullish engulfing, yeah, you see it's not going anywhere, is it? Because what is happening? Price is going sideways. If price is rallying hard and we see a bearish engulfing, we've finished that run, the exhaustion is there, And now there's a chance that it's going to come down. I don't know actually what that does. So let's have a look. There you go. Yeah. Bang. Followed by long wicks. That is a 3-bar reversal. God, how to lead on to the next pattern. That's a 3-bar reversal. Reversal pattern. We'll do that one in a minute. Yeah. But you see how important price action is at levels or highs and lows compared to price action in here. Yeah. And this is why people trade sessions. Yeah. The Asian session is typically very, very quiet and rangy, which is why people don't tend to like trading it an awful lot. The market starts to move in the London and the New York session, and that is when you're going to put in highs and you're going to put in lows. You're going to go to previous areas to test, and buyers are going to add more positions in. These are the areas that you want to look for price action. Yeah. So when you're reading price action, you want to look at it for it at levels that make logical sense. So bullish engulfings and bearish engulfings are mostly the 2-bar pattern that you're going to look for. So 1 bar, really hammers and shooting stars are your main thing. 2 bars, bearish engulfings and bullish engulfings. Yeah, main reversal candlestick patterns, but at logical areas. There are deviations and variations, and there are hundreds and thousands of these things. People make them up all the time. The 3 dark crows and all the, there's just 3 cloud cover in it and dark crows. And there's so many candlestick patterns that you can look at, and they all warrant a look at them. But you have to understand what price action is telling you, and it's telling you that I'm either exhausted or I'm stuck sideways. So you've got to make sure you're looking at levels. That's a good good continuation pattern. So what we're looking at today really is reversals patterns. This is a continuation pattern. Yeah. So price has pushed down and it's continuing to push down. So therefore break short. This is a breakout pattern. You would take a breakout of that, but you would identify it as a 2-bar pattern, not a 1-bar pattern. Yeah, hopefully this is making sense. Hammers and stars we've covered. Bullish and bearish engulfings we've covered. Railroad tracks. I'm just going to try and find a railroad track. These are very rare patterns, but very effective. There's one. Oh, does that one? See, that one hasn't worked. Probably needs to go down to lower time frames to try and find one. Should have prepared this, shouldn't I? But railroad tracks you don't find very often. That's kind of a railroad track, but in the wrong spot. To be fair, there you go. I've lost it. There he is. So railroad tracks basically is where you get 2 candles, which are propulsion candles. I guess that's probably a better example than this one. So that there, and that there are what I call railroad track patterns. Yeah. So what it is it's a bullish or bearish engulfing, or close to a bullish bearish engulfing, where you have an equal amount of bull and bear price action. Yeah. So again, these patterns will appear at highs and lows more, and they are not going to work very well within ranges or choppy price action. Yeah. So you got a big bull move here, which is way bigger than a normal price action, followed by a big bear move, which is a similar size. Doesn't have to be exact, but a similar size to the bull move. And what it is an indication of is an exhaustion of movement, except the exhaustion didn't happen within the candlestick. The exhaustion happened at the end of the candlestick, hour, week, month, day, whatever candlestick that is. And then it just so happened, as the exhaustion point was hit, the order flow was completed, the opposite happened. Yeah. So it's exactly the same as this from a reading perspective. It is an area we've moved to. That's not a bad example. It's a bit of a long wick on it, but that's not a bad example of price moving up, exhausting, and then moving down. Think of looking at a line chart. Yeah, that is exhaustion. On a candlestick chart, you will see exhaustion in that format, or you will see exhaustion in that format. But we're looking at this, and it comes in that format as a single or that format as a double. Yeah. So the bullish and bearish engulfing are very much the same as railroad tracks, but railroad tracks are huge move. It's a large exhaustion move, and you will typically find this pattern at a high or low, because what they're doing is they will run up into resistance, and there will be a large batch of orders which will complete that move and get overwhelmed at the same time at that level, and it will slip. So think about the ladder we looked at, yeah, where the only way that this guy can get his buy order completed is if the guy selling comes to his level or he goes up to that level. What this is him getting here. There's no sellers at this level, and the next batch of sellers that can complete his order are up here. It's exhaustion. It just happens to happen at the end of the candlestick time frame, hourly, daily, weekly, or whatever. And then you start a new time frame, candlestick, and the exhaustion happens, and we come back down. These guys take back control of the market, and you reverse. So it's pretty much the same thing. But when you see a railroad track, this is very rare at the moment. There's one there, but I mean, that didn't particularly work very well either, that one. But it did, you know, and again, it did work. If you're scalping, good job. Yeah. You will usually find a continuation. Whether it actually reverses completely or not is, you know, unknown, isn't it? Because the weight of orders after that's happened is another 5 hours worth of stuff. So, so that's the second 2-bar pattern, if you like. Where it really gets interesting is 3-bar patterns. And there's a number of these, and you'll find literally hundreds of 3-bar patterns. Let me just move over to something else. So the main 3-bar reversal patterns that you'll find are basically 3-bar reversals. So a 3-bar reversal can come in a number of forms, but what you're looking for is the same thing. You're looking for the orders being placed by one party to exhaust and the other party to take control. So there's one here, and this is why I've come back over to this chart, because I spotted this one earlier. This is a 3-bar reversal, and it can come in 100 different variations. But the core of a 3-bar reversal pattern, which tells you that the move is over, or move is likely to be starting to be over, is you have a move by the party in control, the bulls. This is obviously a bull move. Yeah, the bulls have tried to make a move. The next candle, hour, week, day, whatever time frame you're looking at, the bulls have tried to continue the move and have failed. The next candlestick, the opposite party has taken control. Yeah, so it's a 3-bar pattern telling you the same thing: exhaustion. Now, it can come in a number of different ways. This one here is not something that is textbook, but it is a bull move followed by an exhaustion move followed by a bear move. Yeah, and then the market reverses back the other way. There's a 3-bar reversal here. There's a bear move here followed by an exhaustion move followed by a bull move. Yeah, so and this is where the discretion comes in, and this is why this is a discretionary pattern. And another reason I haven't managed to code this into an EA, because there are 1,000 different rules. And if you ask 10 people what a 3-bar reversal is, if they know what a 3-bar reversal is, you'll get 10 different answers. Some people require the low and the close of this candle to be below the open of that candle and the low of that candle. Some people will say the close has got to be below that open. That's all. Some people will say as long as that low's below that low, that's fine. Some people will say that has to have a wick longer than 50%. Some people will say that has to be a doji or a spinning top. Some people will say that that high cannot exceed that high. Yeah, there's 1,000 ways you can interpret this, but at the end of the day, what we're looking for is 3 consecutive candlesticks that show you that the bulls are in control of the market. They've lost control of the market in whatever shape or form you decide that comes, and the bears have taken control of the market. And the strength of this candlestick beyond this one here, however this one looks, is up to you. but it's push, exhaustion, pull. Yeah, you'll hear me talk about this a lot in the live rooms when I come in and say, look, there's a beautiful 3-bar reversal. Yeah, push, pause, pull. That's what we're looking for. The 3 Ps. Pushing in the same direction as the move. Pausing. Indecision. Indecision candlesticks come like that. They come like that. They come as outside bars. They come as inside bars. Yeah, some kind of indecision, pause in the market. And a pull. And this is for a bearish move, yeah? So you'd push, pause, pull. If it's a bull move, it would be a pull, pause, push. Doesn't matter which we'll call it, it's 3 Ps. So that's basically the 3-bar candlestick pattern. And that is your most reliable pattern because it's a confirmation over a longer period of time that what you saw happening was an inside bar, market slowing down, the bulls trying to take control and failing, and then being overwhelmed by the bears. So it's a end of move. And again, highs and lows of days, highs and lows of weeks, support resistance areas. Anywhere that you are expecting price to potentially test and possibly reverse, that is your signal. Yeah. So the reason I'm covering all of these is because obviously a lot of people are looking for ways to get into the market. We know that getting into the market is only the smallest part of trading. You can flip a coin and get into the market, but to give yourself a competitive edge and increase the probabilities of the trade going in your direction, which is at the end of the day what we want, we need something that's a little bit more reliable than a coin flip. And that's all price action is. It is a indication of a criteria being met by bank and institutional movement that means that there possibly is going to be a reversal. And it's always going to be possibly, because a 3-bar reversal will look amazing until someone walks in with 250 million long orders in the next hour. This is an unknown. You will never know what's happening here. But what we're looking for is the move that we've seen happening finishing. What happens next is the future. There's nothing, there is no candlestick pattern you can trade that will tell you the future. There's nothing you can use that will tell you the future, obviously, apart from a time machine. If you've got a DeLorean and a doctor, and you haven't. But that's it. Yeah, so that's all we have, right? So there's your 3-bar pattern. Those are the most reliable patterns. The downside to a 3-bar pattern is you've missed all that part of the move. Yeah, and you're going to find less of them, because we're looking for more things to have happened in succession, one after the other, than before. Yeah. And even then, obviously, there's no confirmation. But add these together, a 3-bar reversal, exhaustion pattern after a long move at an area of support and resistance, or a high of day, or yesterday's high, or last week's high, or last month's high, or a propulsion gap. Yeah. This is your signal. Your condition is extension, bounce point, level. Yeah, every system and strategy needs a condition. Something has happened. An area has been reached. A signal, I've had a confirmation that this area may be doing what I think it's going to do. And then you need a TP and a stop. Yeah, or you need a plan. You need an exit strategy in the backside and the front side of your trade. Because when you get the condition and it's ticked, you get the signal and it's ticked, the next candlestick is completely unknown. Yeah, that's all you have in trading, risk. Yeah, so those are the 3-bar reversals. I'm not going to go into all the others. Because we'll be here all day. There must be one with loads. Right, so there you go. So there's loads of people covering the 3-bar. There you go. So there's another one. The 3-bar play. A bull. This is just price action. Yeah. What's that? Inside bar. Yeah, it's an indecision candlestick. Inside bar. There we go. There's the bullish and bearish 3-bar reversal. And you'll see people, look, right, so a 3-1-2. There are so many variations on this. There's a load there, look, load of different ones that you can literally drive yourself mental. And you can say, I much prefer the ones where that goes above there, or the ones which are down there aren't as good. But in my experience, the odds of these working out is roughly the same, because it's an exhaustion move and a reversal potential. What happens on the next bar, people don't understand that this is the unknown. They're looking for, oh, over the past X number of times I've tested this, this one worked 60%, this one worked 35% over the test period. Now use the test period before. Are those the same? If you've got a test period where the odds of those working out are the same, and you in sample test it and out of sample test it and you forward test it and you get exactly the same percentages, come and talk to me. You won't, because it doesn't work that way. But that's what everybody's trying to strive to do. Oh no, you shouldn't have taken that because the high of that isn't above that. Rubbish. The market's exhausted. It just happened that there was a weight of orders bigger on the next candle. Yeah. So those are your 3-bar patterns. There's loads and loads and loads of others. But at the end of the day, you're looking for a push, a pause, and a pull. That's it. The others are wick related. Yeah. So I call these the tweezer tops, and we call them what you like, really, but I call it what it is: multiple tails. Really easy. So again, it's all to do with price action. There's a tweezer tops. Yeah. So what a tweezer tops is 2 wicks, regardless of the length. It doesn't matter how long those wicks are. But basically, a tweezer tops is on any time frame. It's a candlestick where the high is pretty much the same as the high of the previous candlestick. This is an iceberg order. This is a bank or institutional order sitting, defending a level. That's simply what it is. Yeah. This is a tweezer top over a period of 6 hours. Yeah. So tweezer top patterns are basically just double tops. In this case, a triple top. Yeah. So depending on how far you're zoomed into the chart and what time frame you're looking at, all this is showing you is a current resistance level. That's it. So price action at resistance is what a tweezer top is. Yeah, this one, the more times it hits it, obviously, probably the more weight you've got. But it's a short-term reversal pattern. Yeah, it means that the buyers have come running at a level and they've hit a brick wall of $100 million worth of shorts. And they've gone, we can't get through this level, screw this. And then someone's come in and gone, I got a load of orders. Oh, we still can't get through this level. Yeah, short it. Because these guys aren't letting you through. Stop loss above that high, off you go. How far you go, unknown. Because this guy is sitting here with 100 million. Unless this guy moves down with the rest of his orders to this level and drives the price even lower, it's probably just going to keep doing that until this guy's orders are 0, and then it will break through. Yeah, think about price action, understanding how and why the market moves, which we covered on Monday. Yeah, it's all to do with literally volumes of orders at levels. And all a tweezer top is showing you that this level here has got a load of sellers in it. What's this? A 3-bar reversal. Yeah, you got told it was a short there. You got told it was a short there. Yeah, you got told it was a short there. We came and had another go at it. This guy's finished his order, so we popped it. Yeah, doesn't mean it's going to come down. And this is the important thing about price action candlestick patterns. They work really well, and they will give you a reversal. They will tell you that there's a reversal coming. This part, after the reversal, is unknown, because we know that this is an area that we are either exhausted at or we cannot penetrate, but we do not know what the weight of orders is going to be in the next hour, 3, 5, 7, whatever, however long after that entry, which is why risk reward strategies using price action are very, very hard to make work. Because if you think about it, we know when to get in, but what we need is the market after we get in to move a distance that hits a level we have selected. That isn't the case. What the market will tend to do is hit a previous level and then bounce out of it, because that's what it did last time. So if you get into a risk reward trade based on price action and that is your risk, and your reward needs to be 3R, yeah, you may not achieve it if this is the point where the buyers took control and will add back in, which is why I target propulsion. Because I know if I go short here, we know that this tweezers are bottoms. We know the buyers are buying here and adding size. If I short on a, there you go, perfect. Well, look at this, how to pick the perfect chart, right? What's this? 3-bar reversal. Yeah. Push, pause, pull. Didn't get down below there, but I couldn't take this one because obviously that's the close of the candle. But if I had shorted it, I'd obviously, that would be my target. So when you look at that particular trade, if I was going to use that as my stop loss, the reward isn't big enough. So you just wouldn't trade it, would you? Got to have a bigger risk reward. But so that's basically, what was I talking about there? The tweezer tops. Yeah. So tweezer tops and tweezer bottoms is basically exhaustion being seen twice. You will often find that tweezer tops again appear at the end of a move where we push up and we get rejected and we have another go and we just can't get through that level. And the reason that that run ended at that level is because a bank was sitting there, probably been sitting there from a couple of weeks ago, just shorting the market at that level. You won't get through it. So it's just multiple rejections, yeah, but more than once. And you can have this happen again over multiple hours, weeks, or candlesticks. Yeah, so this is an hourly chart. So we hit that level, yeah, and then we push down and we hit that level again, and it's basically a double top. But the important thing is there's rejection, yeah, at the double top. If it was a candlestick that closed like that, and then 4 hours later we had a candlestick that closed like that, yeah, there's no rejection. Yeah, we're looking for exhaustion and the bears to just take control at that level. We need to see this market participants, which is why we look for wicks. The last one is multiple wicks. And multiple wicks is basically, I've classed it as a reversal pattern because it typically is. But multiple wicks is this. Yeah, so, and these ideally should be within a row, but again, it's a little bit discretionary. But if you see this happening on a chart, multiple wicks, where you get hammer or shooting star in this case, followed by shooting star, followed by a doji, followed by a shooting star, where basically the price is basically rejecting a level over and over and over again. Again, it's another iceberg order. It's a bank or an institution sitting there with a huge amount of cash coming into it and saying, yeah, I'll take that lot. Yeah, I'll take that lot. Yeah, I'll take that lot. Yeah, carry on, bring it to me. And these guys that are longing this market to try and make money will go, not happening today. They will flip short and they will go back the other way because they can't get through this level. So they will execute their short orders until such time comes that they can execute their long orders at a later stage. Again, think how the banks and institutions work. Their job is to execute orders. If I can't execute the orders because either I can't get the established price I need, or there's nobody there that's willing to sell to me at the price I need, I won't execute the order. I can't execute the order. But on my desk, there'll be a shed load of orders in the other way I've got to do as well, because banks and institutions don't just have buy orders. They have buy and sell. But they will always try and fill their own orders into bank, but they will always be left with a level of, I've got more than this, more longs than shorts, for example. Or a portion of those will be, I can't execute that one at that price because this guy wants this price. So I've got to go long with up here and I've got to go short down here. So I can't match those orders together. So there's an imbalance, as the banks call it. Imbalance in an order flow. Yeah. So that is telling you, you need to go short because you can't get through that level. Look at that there, how many wicks we've got. And these will usually appear multiples. And again, it's usually at least a 3-bar pattern. Yeah. So anything you see on your chart, and you'll probably see me say things like this in when I'm trading in indices specifically. So if I'm short on something and I look at it and I just see rejection after rejection after rejection and I'm long, I will close it. Sometimes it will fly, but most of the time, the reason you're getting the wicks is because the market is exhausted. Yeah. And you will always find long wicks at periods of previous exhaustion because it's just bank and institution executing orders within what? Balance, which we covered the other day. An area of agreement between institutions that this is the price we are happy to trade at. Until that agreement ends and there is an excess of orders in one direction or the other that needs to be executed at a different price, the market will then try a price discovery move, which will either succeed or fail. Yeah, that's just how the market works. So all these price action patterns are telling you is there is constant rejection and potential reversal. So just scanning through, there's another one there. Yeah. So we pushed up, we rejected. We pushed up, we rejected. We pushed up, we rejected. They're not the same length. Yeah. We're not looking at tweezer tops are a level. They're the same level. A multiple, what do I call it? It's multiple tails. It's kind of the only best name I've come up with for it. Multiple tails are just shots and attempts at getting through an area, not a level, in a line in the sand, if you like, a rough area, a support resistance area, a zone, a propulsion gap where you're going to add at whatever price you can get, but not let the price through. Yeah. So they're like blockades, if you like. Yeah. Tweezer bottoms. And again, I put it into Google, but yeah, so there you go. So most courses, if you want, or whatever, will teach you that they have to be at the same price point, because a lot of banks and institutions will have algorithms sitting at a level. Yeah. So the way that algorithms tend to work is there will be a level they will be told to sell at, but there will be a deviation element, because if a volume comes at that level which is higher than the volume you have available there, but you have more volume to add, you won't put it all in the market at the same time in one price point. You will add to it. So algorithms work in the fact that they execute 10 million short, reload 10 million short, reload 10 million short, reload 10 million short. In the time you've reloaded, price can exceed that level, but you will add 10 million and then another 10 million to drive it back down while you're defending that level. It's just the way they work. So there's a deviation built in, and this is basically their risk. Yeah, they're buying and selling on ticks. So they'll say, I want to sell at 86,125 with a deviation of 127 to 123. I will accept orders at those levels. That's why you don't get them exact. Exact ones obviously are a little rarer, because the chances of getting exactly the same are but if there's a deviation which you can hardly see with the naked eye, none of these ones on the chart here are equal. Yeah, they're not equal. They're not equal. They're not equal. Yeah, but they are equal. They are tweezer bottoms. Yeah, tweezer bottoms together, tweezer bottoms a few candles apart, or tweezer bottoms that turn into 4, which is multiple wick rejection. Yeah, it's basically just exhaustion. Yeah, so it's telling you that the market is running out of steam. So that's pretty much it on the candlestick patterns for reversals. I have built an EA in the past, and I have programmed into it everything I've ever found. Yeah, so from my years, railway tracks. There you go. I call them railroad tracks, but railway tracks. Yeah, well, they've got tweezer tops and tweezer bottoms in their railway tracks. They call it something different. There you go. Cord of wood. That's another pattern. A cord of wood I call Christmas trees. And the only reason I call them Christmas trees is because they go red, green, red, green, red, green. But if you're using black and white ones, obviously you wouldn't call them Christmas trees because they're not red and green. Just the Christmas colors, isn't it? But you know, that is an accumulation. That's a breakout pattern. But so that's basically it from that perspective. There are hundreds of others, and the EA that I built in every candlestick pattern I could find that to me made logical sense. And I tried to trade them all with a 1-to-1R risk reward ratio to see if every time a bullish engulfing or a bearish engulfing happened, this happened. You get an edge out of it. Every time you get tweezer tops, you get an edge out of it. Every time XYZ appears, you get an edge out of it. My findings were inconclusive. Sometimes it worked, sometimes it didn't. Then I looked at variations on them. So what if the tweezer top could have a variation of X pips? Has that got a difference? So we're going to get more of them. That just made it worse because you've got more trades, therefore you've got less strength in the trades and they don't work as well. So I tested all of this and my conclusion was they all work sometimes and all work and sometimes they don't. But, and this brings us on to the next part. We're an hour in, so I'll do this bit tomorrow. But this is to do with levels. Yeah. These candlestick patterns, we are trading a price action. Yeah. On their own, price action works pretty well. Add that into the equation, the odds of those patterns working exponentially increases. Yeah. Which is where you come into scalping realm. So using price action tells you that there's a probability of something happening. And usually it's a high probability. But the price action pattern alone is not what makes the trade work. It's the fact that it's happening at a level of support and resistance that has increased probability. Propulsion gaps, which we're looking at with Harold's strategy. If you waited for price to come into a propulsion gap and didn't wait for price action and just hit the button, it's going to work sometimes, isn't it? However, if you wait for price action inside a propulsion gap, the odds are exponentially increased because you've got the odds of this working combined with the odds of the price action working, which gives you more probability. Think about systems and strategies, the video that I did on that. We are solicitors. We're putting together a case for our trade. So I've got a reversal alert happened. That gives me an indication that the market may be going short. I've got that happening at an RSI extension, which gives me more confidence. And that RSI extension has deviation, divergence, which gives me another confluence. It's also happening at last week's high, which happens to be the previous month's high, which gives me even more confidence. And we're currently trending down. That is a much better trade to take than just a reversal alert. And it's the same with price action. If you take price action at support resistance, you're going to get much better results in everything that you do. However, and this is where the problem comes, automating this is very difficult because there's thousands and thousands of ways of interpreting price action, and there's thousands and thousands of ways of interpreting support and resistance, supply demand, whether it pierces it, goes above it, has to be above it, has to be below it, the wick has to touch it, we've got to have this, we've got to have that. But by the time you program all of those variables in and do a system parameter permutation on all of them, you've done 100,000 tests. There is no conclusive proof of anything. And there's no this is better than that, because sometimes this is better than the other. Yeah. So it's always with price action going to be a discretionary tool and not something you can use as a fixed, this is what I'm going to do. But it is the best signal out there to get into a trade, which is why I built this. Yeah. The market reversal alerts indicator is a combination of price action over time. Yeah. So we've got the bulls breaking a previous level, which you will find has got some kind of exhaustion. This bit down here, when I was building the market reversal alert CA, and the way it works basically, if you don't know, let me just find a better example, because this is all to do with price action. The way that it works is we take the last downward move before a high is made, which is the last batch of bank sell orders, yeah, before that high is made, and that low there is what we say, well, if the guys that tried to sell here actually succeed, we know that the bulls have finished. That's what a reversal alert is. It's basically saying the guys in control before we made the high have now won. It's the battle is over. Yeah. So that's what a reversal alert is telling you. I tried for a long time to look for something in here within this block that could give me better confirmation of it being a more reliable reversal alert. Yeah. So I looked for, you've got to have an M pattern within it. So you have to have a high, a low, and a high. I used zigzag. I used all sorts of things. I used price action. There's got to be a long wick in there. This high has to be higher than that one. This high has to be lower than that one. I looked at every possible combination of price action within the reversal alert to try and increase the probability of the indicator. There isn't any, because sometimes they work and sometimes they don't. Sometimes the reversals work and sometimes they don't. Why? Because at this point, we know that the sellers are taking control, but at this point, we've no idea how many bull orders are coming into the market. So yes, we've got them winning now, but no, they may not win in the future. Yeah. So it's all to do with price action, long wick rejection. Yeah. How far this goes has got nothing to do with the long wick rejection. The long wick rejection, the price action is telling you that the move is over. What's this move going to be? No idea. No one knows what the next move is going to be, how far it will go, and how quickly it will work, because this is fresh price action, fresh orders, fresh volume, fresh order flow that we've never seen before. So that's all price action can tell you, is that right now is the time to get in if the market is going to continue to do what we expect it to do, which is why this is the best place to do it. And this is the best place to do it. Yeah. At turning points. But you don't know if it's a turning point until after it's turned. But you've got to have a reason to get in. And that's what reading price action is all about. So there we go. That's that cover. That's that session done. Anybody got any questions on that session? And if you're watching on the replay, use the comment section or come over to Discord. Linus wanted to buy, I've covered that one, haven't I? How about big body closed candlestick through a structure point? So that's a strong closed candle, yeah? Yeah, so that's a breakout. Propulsion gap. So a strong closed candle through a previous support. Yeah, absolutely fine. It's basically a reversal, but what it will be doing is you'll have missed the price action. It's happening, it will happen after price action, typically. If you've got a range you can identify and you get that strong closed candle breaking out, some point in here within this range, there will be a price action pattern that tells you this is coming. There'll be a rejection pattern that tells you that this is about to happen. Look at this one here, right? So big strong move down. What happened before it? 4 long wicks. Rejection. Before the move. Yeah, this is telling you, price action is telling you, the buyers are exhausted. It's not a very long move, is it? So, you know, this is again the discretionary part of trading. What you class as an up move could be that. You could say it's got to be at least something like that. Or it might need to be bigger for you. It's fully discretionary. But reading price action is all about identifying what's going on under the hood. We know how the market moves. We've covered bank and institutional movement, which is what drives this up and down. It's purely random order volume. Our job is to identify when that volume will either continue or change. Identifying when it continues is very, very difficult. Identifying when it's starting to run out is a lot easier, which is why mean reversion is easier to do, because we have levels we can see where they've run out before. We have clues on the chart which tells us at the moment they seem to be running out of steam. They're running out of steam at a level they ran out of steam before. It's a high probability entry. Then you manage risk because the next candlestick is random. You don't know what it's going to do. Yeah. So those work. Strong closed candles are good, but strong closed candles are here, right? So this is absolutely spot on example, yeah, of what I've just said. Look, this is a strong closed candle through a previous resistance. Yeah. What came before it? So that was your entry. This is your exit. If you're entering at the exit point, you've reached exhaustion potentially. Yeah. This 3-bar reversal at previous support with a bullish engulfing was telling you that this market is potentially reversing. That's your entry. You get out when the breakout has achieved. Yeah. This you can take as a breakout, but what you're doing now is you're trying to get a much bigger move out of it, which again might work. It didn't in this case. Yeah. You could use a stop under there because what? Harold's strategy. Look. So Harold, this is your strategy. Yeah. What we're talking about with the propulsion gap strategy is a strong closed candle. Before the strong closed candle, you'll have had a clue that the strong closed candle is coming, or it'll be a news event and you can't have any clues about that. Yeah. So that could be your stop loss. Yeah. But Harold's strategy gets in there because for the propulsion gap to have formed, you need candle 1, 2, and 3 to complete so that you know that that low is above that high, creating the propulsion gap, which means your entry is here. And as soon as you get in long, the market sits around for a bit and then it pops up a little bit and then comes down. You wouldn't have got a 2R out of that. You would have got maybe just about a 1R, maybe. Yeah. So strong closed candles are breakouts, not mean reversion. Yeah. So that's why I haven't covered strong close in any detail, because we're looking at reversal patterns. We're looking at ways to get in as tight as stop. If you're going to trade stop loss based strategies, you've got to have a tight one. You've got to have a tight stop, because the movement that comes after your entry is a random order flow. So to get a 1R, your risk has got to be small to get a 1R. And if you can do that 1R more than 50% of the time, that's all you need to do. Yesterday, I took 3 trades using the price action toolkit, doing the exercise I posted, which is, that building muscle memory, taking price action trades with 1R. Yeah. So, I see that. I'm going short here with 1R. Yeah. That one would have been a loss, but it's building the muscle memory, that exercise. So I did that yesterday. I got 3 out of 3. But the reason I got 3 out of 3 was because I was targeting 1R. And if price is just going to go up and down for the next hour, I'm likely to get my target hit. All I'm warranting is the target gets hit before the stop. But when I get in because of the price action, what happens after it is out of my control, isn't it? So this is a great breakout strategy. And we know that it works, propulsion, but it only works a percentage of the time. And it's just not as good as that, is it? But there's no right and wrong. You've got to trade what you want to trade. The reason I use higher time frames and I use position trading as my main strategy is because everything else is unreliable. There's a beautiful 3-bar reversal on the hourly time frame. Look at it. Lovely. Push, pause, pull, enter, short, stop, profit. Done. Lovely. But what did I get? 1R. The problem everybody has with any price action trading strategy is they always try and get a higher return. You're not going to get that because this is all random. The next guy that comes along with 200 million is not going to let your trade work. But these guys that have finished their move are unlikely to enter again. Yeah, so you've got some wiggle room to make some money, but you're not going to get necessarily a massive move unless you've managed to do that thing that we try to do all the time, which is time the market and pick the exact top or the exact bottom of a move. Very, very hard to do. But in the case of Aussie New Zealand, very easy to do when you see price action, bearish engulfing happening at resistance. But I didn't take this because of price action. I took this because of the resistance. And I had a trailing buy order. So I had a trading sell stop set on the 15-minute chart to just move up with price. Just so happened, as soon as I pressed the button, it went short. And I timed it perfect. But how many times do you time that? But look at what happened after. Yeah? If you'd have got in, I mean, if you'd have got in there, that's a fantastic trade. But look at how many opportunities you had to get out here. And how often that happens. It's not often, is it? You can pick the top to that that exact level. Just doesn't happen. Would it be possible to see the trade price action, to see you trade price action with Price Action Toolkit EA in real time? Yeah. We can do that in a session. Kind of need the market to be moving. Could do it on the 1 minute chart, I suppose. It's probably, I'm just trying to think of the best way to do it because it's not something, I'm just conscious we've gone on for an hour. When you're trading price action, you're waiting. Yeah, 90% of this job, and this is why everyone struggles with it, isn't it? 90% of this job is waiting, sitting on your hands. Yeah, doing nothing, which is why I built the dashboards, because I found myself constantly skipping through charts, looking for opportunities. So I thought, well, if I just build a dashboard that goes ping when there's an opportunity, I don't even have to sit on my hands. I just wait for a ping. So I don't even have to be at my desk because I can look at my phone when I get an alert. Yeah. Price action is the same. If you look at the indices at the moment, let's just look at them. There's one that's open, so look at the DAX. Yeah, so you, on the 5 minute time frame, you will be sitting here basically watching this, waiting for something to happen on it. So right now where we are, it's bullish. We've got an outside bar formed, so I wouldn't have done anything there. I'm not doing anything here. So what you'll literally be sitting here doing is watching me sit here for possibly anything up to an hour, waiting for something to happen, which is fine. The best way to do it is probably actually in the strategy tester. So is to go into the strategy tester and use the price action toolkit in there. Then we can speed everything up. But I wouldn't want to do that on a 5 minute time frame because it would go too fast. So yeah, we can do that. We'll do a session on it. Maybe we'll try and squeeze tomorrow. We'll try and squeeze identifying levels together and targets, because actually they're the same thing. But they're not. But they can be. So maybe we'll try and squeeze those two together into one session tomorrow, and then we'll do a session on actually trading. That's a good idea. 5 PA trading. Yeah. So what I did yesterday, I'll just quickly show you what I did yesterday. Oh, I can't, it's on a different account. But yeah, all I did yesterday was I took 3 trades because I found that document, which I posted kind of the instructions of, if you like. But that was a exercise that Dave, when he was working in banking, was given to do. So he was given the ladder, but it's the same thing with price action. And basically he was told, like I said in the thing, was to take 5 trades. Yeah. And your job is, when you can consistently do 5 trades in a row and come out with an edge, put your hand up and we'll give you an account. Because if you can't do that, you're no use to us. Yeah. So that's the job, is reading price action and reading ladder, reading order flow. And there's lots of ways of doing it, but at the end of the day, what you're doing is not learning anything specific trading price action. You're building muscle memory and seeing the same thing repeat. So you will identify, and this is why I've thrown every other chart pattern away, every other Elliott wave, your harmonics, your every other candlestick pattern. I've thrown it all away because the ones I've just shown you are the ones that indicate exhaustion in bank movement, and bank movement is what makes this move. So we're identifying when the thing that drives it up and down is potentially happening. If something draws a lovely butterfly on your chart in harmonics, I don't care. That is an outcome of random price action over time. It is an exhaustion point followed by a lower exhaustion point telling me the bears are in control. You will tell me at that point that the bears are in control. I know that. I can see it. This market structure tells me, you give me a signal down there to get into the market, you're bloody late. I've done it. I'm out. I got in here and I got in again here. Yeah, it's all, everything else you see in trading is giving you a way to get into the market. It doesn't help you because when you get into the market, it's either going up or down. We haven't got control over that, but we can see exhaustion when we know that bank movement is finishing, and that's what we should be focusing on. This is what the market reversal alerts tells you. When the market reversal alert indicator gives you a structure break, it means that the buyers have no longer got control of the market. Brilliant. Now, if they can contain control of the market, brilliant. That's what the indicator's for. It's signaling a short. It's late a lot of the time, but people need a reason to get into the market, which is why I built that, because when I was trading market structure, I wanted something to tell me when to get into market structure breaks, and that's what it does. It's nowhere near as good as price action, but price action is also less reliable and more choppy. That's a beautiful signal to go short. Yeah, but what is it? A single candle. It's a 1 bar pattern. 1 bar patterns on their own aren't great. If it was followed by another bar confirming that bar, excellent. It's not. This is almost a 3 bar pattern. It's a push, a pause, but there is no pull. Not tradable. Yeah, hasn't worked, has it? So we sit, we wait. We wait for confirmation that the bears here are in control of the market. The next candlestick said, no one's in control of the market. The next candlestick said, the bulls are in control of the market, but the bears also were in control of the market. Yeah. So we've got a potential sell followed by indecision, followed by indecision, followed by indecision, outside bar, followed by, at the moment, indecision. We don't do anything today. We sit here, we wait. But the 1 bar pattern traders will have gone short here with a stop above the high, and they're sitting in it. It may well work. It may not work. But this has nothing to do with that. Yeah. So all you're doing when you're training your muscle memory is you will take this over and over again. Sometimes it will work, sometimes it won't. But what you'll notice is the ones that work will be followed by something else, and you'll suddenly go, that doesn't work on its own, but when those two are together, they work a lot more. And if it happens after a push, they work more. The more you see it, the more you'll convince yourself. And part of trading is not taking crap trades, not over trading. What's one of the biggest killers in trading is over trading. People overtrade because they can't wait. You can sit here all day. If this thing does this all day long, yeah, and you get to the end of the day and you haven't taken a trade, that is a bloody good day. Why is it a bloody good day? Because you followed the rules. You didn't take a trade because there was no trade. What didn't you do? Get chopped to death. Win. No. Yeah, that's what the tester does. And you know, using things like the price action toolkit in the tester, because you can download that for free. You don't have to buy the price action toolkit to test it. You can use the demo and use the strategy tester and train yourself. And the strategy tester is the most underrated thing in the planet, because to build muscle memory, you have to spend time in front of charts. And if you can spend time in front of charts, this is an hourly time frame, yeah, So instead of spending 24 hours in front of charts, watching charts go up and down, you can do that. And you've seen, I mean, obviously not that fast, but you've seen 24 hours go past 1,000 times. You can do that in 10 minutes. You will build the same muscle memory. You'll just do it quicker. I was told to go in here and do the exact thing that I've just said to do in the group. And it makes you see things without even thinking about it, because you see them over and over again. There's just nothing that stands out on this chart to me at all as good. There's one 3-bar reversal, which is mediocre there. But there's just nothing that stands out to me, and I'm scanning. But it's because my eyeballs automatically see it now, because it's time. It's all to do with time. This is why people can't just learn a strategy and trade it, because there is no way of just learning a strategy and trading it. You've got to learn a strategy, trade it, understand why it works, why it doesn't work, and build the muscle memory to identify the best ways to do the thing that you've just been told to do. Because mechanical trading strategies are very hard to make work, because they will not fit the market conditions all the time, which means you then stop trading them and you hop somewhere else. It's the never-ending cycle we go through in it. So, right, it's 20 past 10. I haven't got much time to do anything else today. So the other thing I would, unless anybody's got any other questions, if you've got any other questions, chuck them in now. I will cover them. The two things I want to do with the strategy development side of things, obviously Harold's strategy I want to look at more, but there's 1,000 ways of doing what that strategy. The reason I'm a little bit reticent on it, and not because I'm not convinced, but is I have tested this strategy quite a lot in the past, because I have built the propulsion gap indicator. So I tested EA development on it and I couldn't find an edge. Admittedly, I have never tested it on indices. The problem with forex with this particular strategy is it is a breakout strategy, and breakout strategies in forex aren't very good, because forex spends an awful lot of time doing this. Yeah, breakout strategies fail during ranges. Yeah, and there is a lot of breakouts during ranges. Propulsion gaps tend to be part of ranges. There are large moves trying to break out of a range and failing. So reversing that move can be quite good as well. And you've seen the difference I showed this morning in the live room. The impulse strategy, which is very similar to the propulsion strategy, except it doesn't need that third candle confirmation, works better in reversals. Yeah, but the problem with doing that in the propulsion gap strategy, as Harold said, either in here or in the live this morning, when you get a propulsion gap, doing that is probably going to happen. But the risk reward is almost impossible to determine. And by applying random risk rewards to it, what you're actually doing is introducing a completely random variable, which is not going to repeat itself. So mean reverting propulsion moves is actually harder and not as reliable to do. The other thing I tested with this strategy is the retest. So I built an EA to get in here. So propulsion. And I said, okay, when we close in here, long it. Yeah. And stop under the low. But what I also found was that didn't work very well either. So I need to do some more testing on this, and I need to spend some time applying different criteria to it to see if there is any exit strategies we can apply to this that give it an edge. Reversing the direction of it, I don't think is going to work. I can easily do that by adding a reverse input, and it will just take the opposite side. So I can test that very easily, and I will do. But I need to spend a little bit of time on this, a couple of hours, just applying different models to it. But I think where this has potentially got legs is in indices, and specifically at the open. But what are we describing? The opening range breakout strategy. I already have that, and it has an edge. I know, because I trade it. Yeah. So propulsion gaps on indices are going to happen at the open. The open is the opening range breakout strategy. I've got an EA that does that already, ORB, and I've got one that does the hedge variation of the ORB strategy. So I will test this on indices. But what you're going to find is, and again, this is where I keep going on about this all the time, and this is kind of proving my own point, isn't it? All strategies are the same. They are either breakout, they are either trend, or they are mean reversion. Yeah. Here was a propulsion gap formed by the open. It worked. We get propulsion gaps formed at the open, switching over to the FTSE. There wasn't a propulsion gap today there, but we get propulsion gaps at the open that also don't work. Yeah. So by testing this on indices, what we're doing is we're really going to be trading the open. And the open is twice a day on UK indices. We have the New York Open and we have the London Open. Yeah. So, or we have news as well, which obviously drives it. So news ones are the same. They will work quite often, I think, on indices. So I'm going to test it. But at the end of the day, it's the propulsion gaps. The propulsion gap strategy on indices is the opening range breakout. I think you'll find most of the time. So we got one here that works beautifully. Look, the entry was there. Yeah. The stop is there because that's the propulsion gap. Then we put in another propulsion gap. So that's your risk. The problem you're going to have on indices is that getting the risk reward is very difficult, which means you've got to control the size of the propulsion gap. It needs to be less than 20% of the average daily range. Otherwise, you're not even going to get a 2R out of it. So I will test it on the indices, and that's part of my plan this afternoon, which is why I don't want to go on too long in the live stream because I want to try and do this. But I think you're going to find you're not going to have a different edge to what you would have trading ORB. But we will try it and see. What do you think about heat maps? In what respect? Heat maps of what? That's more stocks heat maps. Is that what you mean? So heat maps. You mean this stuff, yeah? Is that what you mean, Linus? Again, it's the same as everything else, if this is what you mean. But I mean, you can apply a heat map to anything, can't you? You can apply a heat map to forex. You can apply a heat map to individual indices. I saw on Instagram and didn't know what you were looking at. So yeah, if it was this type of thing, all a heat map is an indicator. Yeah. So it's the same as currency strength. This, right? So what does this tell you? It tells you that the weakest currency at the moment is the New Zealand dollar, right? This is going to be a no shit moment. Look at the New Zealand dollar today. No shit. Yeah. All a currency strength meter tells you is what has happened. I know, I can see it because what? Price action told me. Yeah. This is, remember when go back to yesterday, what a candlestick is telling you. And remember what I said about price action. It is the least lagging indicator you have. It's still lagging because that hour, the bears are in control. Okay, that's great. So it's told me that the most recent thing that's happened is the bears have taken control of the market. The currency strength meter in forex is telling me that this is the weakest thing. I know that because I saw a big candlestick go down and there's been many more. And now you're telling me that this is going down? Thanks for that. Heat maps in stocks are telling you Amazon is down, Apple is down, Google is down, Verizon is up. I know that. If I go and look at a chart, the candlesticks will tell me this. So these are indicators that lag price. How you use them is entirely up to you. The main way that they're used is in stock, and this is why I typed in sector heat map rather than stock heat map. The main way they're used institutionally is for long-term hedge positions and long-term investment positions, pensions, that sort of stuff, to tell you what sectors are currently hot and cold. So what you use this for is, today I'm going to come in and I'm going to trade tech. Why? Because tech is active. There's a lot of red. It's not, I want to trade tech short. I want to trade tech because tech's moving. What should I do today? Trade the NASDAQ, not the S&P, because tech's moving. Yeah. If you come in and all the commodities are moving, it's not, I can't be jealous with this chart, but if you come in and all the industrial goods trades, stocks are moving, if these are all massively green, you would look for opportunities to get in on industrial goods stocks. Yeah. But this is telling you what's happened. Industrial goods have gone up. Yeah, excellent. So how do you use that information? Well, you're either going to mean revert it or you're going to look for an opportunity to continue. What are you giving yourself? An opportunity to press buy or sell with a 50% chance of the trade working. This helps you pick which one's moving, because if something isn't moving, you can't make money. So it tells you what you should trade. So today, on the currency strength meter, anyone using this properly, which is what they don't do, will be going, I need to trade New Zealand dollar today. But they won't be saying I need to sell New Zealand dollar today. New Zealand dollar's moving. It's going to move potentially today. Why? Because the banks have moved it. What happens after they move it? What do we do all day long? Mean revert bank movement. Yeah. What's today's opportunity? ADR long. This is why these indicators are here. This is my heat map. What's moving? That is. Let's see if we can get a trade on it. Yeah. Same stuff. Everything you see out there on the internet, every course, every indicator, everything you see in this industry is telling you the same thing. Yeah. They're all telling you the same thing. Here's an opportunity to press buy or sell. What happens after that, nobody focuses on. That's the bit that makes you the money. I can give you a billion reasons to trade today. Look at this heat map. If this was a live heat map, I'd be going Google, getting Google. Which way should I go? I don't know. Look for price action signals to tell you which way it might go next because it's had enough. But trade Google because it's moving. Yeah, it's just an indicator flashing at you saying, trade me. But everyone will try and build a system around it. But at the end of the day, it's binary. It's red or green. It's up or down. It's long or short. That's all you've got. You apply risk to it and an exit strategy to a binary input. That's it. That's trading. Yeah. Don't overcomplicate. But if, and again, this is why you have to try stuff. If you find this stuff, you latch onto this and you go, I'm going to start trading that way because of this. And you suddenly find you're profitable. What you've done is you've eliminated what wasn't working. And what wasn't working, if you suddenly pick up a heat map and become profitable, the reason you weren't profitable, but you won't know it, is because you were trading dead instruments that went up and down and stopped you out all the time. If you trade live instruments that are moving a lot, the more likelihood is they're going to trend and rally, and there's less likelihood of what? Your stop loss getting hit. So you're going, oh, I trade stock sectors now because I'm profitable at them. No, you're not profitable at them. They're just moving. You've just identified unknowingly that the only way you make money is by the thing, when you press the buy or the sell button, moving. Yeah, ADR, AWR. We don't trade ADR reversals and AWR reversals and stuff like this monthly reversal. We're not trading this because necessarily it's hit its monthly range. We're trading it because it's moving. Yeah. If something sits there and doesn't move more than 20%, that hasn't even done half its ADR yet. CAD Swiss, it's doing that. Yeah. So if I press the long button here and it does that for an entire month, what am I not doing? Making money. So don't get involved in it. If it has moved, the banks and institutions have a whacking great load of cash in their P&L. To take that cash, they have to do the opposite. So trade it. Because it's going to move. If it has moved, it will continue to move most of the time. That's elastic band theory. That's the bootcamp. That's position trading. That's what we do. Well, I do. So yeah, so there's nothing wrong with them, but understand what they're telling you. Don't look for clues. Don't go, oh, Microsoft's up 39.92%. This X, however long this heat map is measuring over. Don't go and buy Microsoft. It's moved. You've missed it. It's gone up 39%. Do you think it's going to continue to go up? What do you not do? Buy at the top. Yeah. People go, hey, Google's on the move. You see this a lot. You see there's stock screeners called movers and shakers in most stock trading platforms. Ninja Trader, they all have the same thing. But what the movers and shakers is telling you is this thing is on the move. Yeah. If this thing is on the move and up 2% today, and on a normal day it goes up 0.5%, you've missed it. Yeah. It's identifying what is likely to move today. What's got earnings coming out shortly? What's happened in the sector? Elon Musk has announced that Tesla is going to drop drop the price of its cars by half. What are you going to go and do? Look up all of the companies in electronics that supply Tesla, and you're going to buy those stocks, because Tesla's stock price is about to fly because the sales are going to go through the roof. These guys are going to need to manufacture more parts. Their stock price is going to increase. When it's increased and this sector heat map has said, hey, this stock price has gone up, you've missed it. Stock trading isn't about identifying what's moved. It's about identifying what's going to move, which is why it's so bloody hard. Why I don't do it. On an intraday level, this is useful. So this would tell me today I need to trade Microsoft and Google and Meta. This must be annual, because these are 134% up. This is an annual heat map. Yeah, 2023 or something probably. But you know, if you're scalping price action movement, if you're trying to do and this is what we're covering, reading price action. If you're trying to do that, you need stuff that's going to move. So look for news, right? So news trading today, we haven't got much, but FOMC. Tomorrow, we've got CPI tomorrow, yeah? So tomorrow, we've got CPI. So at 1:30, the US dollar is going to move. So tomorrow, what your job would be is let's trade pound US dollar tomorrow afternoon, and we'll drop down to M5, and we'll see which way the news takes us. Yeah. When the news has taken us in a direction, we will look for price action signals that the move is over, and we will trade them intraday on the 5-minute time frame. Yeah, but you can't anticipate that. You can see it and then anticipate what happens after it. That's trading. That's the best way to make money that I've found. Everything else is just guesswork, isn't it? Search up forex heat maps. I think it's to find the liquidity. Oh, Bookmap. Yeah, I've got Bookmap. I've got Bookmap, and I have also got Jigsaw. I've got Jigsaw. Bookmap is came after Jigsaw, so I've got Jigsaw. This is what we covered the other day. When did we cover this? On Monday. You can go down this route if you want to, but this basically is showing you where orders sit. So this isn't for forex. This is for stocks and for futures, trading currency on futures markets. So the futures markets have a centralized exchange. Yep. So every transaction, whether you are me, or a institutional bank, every single transaction goes through the Chicago Mercantile Exchange or the ICE network or another main central trading hub, which means that every single trade is logged, and you can see the volume of every single trade, and you can see where every single trade is in the future as pending orders, limits and stops, or executed orders. Bookmap and Jigsaw show you a heat map of where those orders sit. Yeah. So remember the ladder. That's not a ladder. Remember the ladder we looked at? Yeah. Um, yeah. We looked at this. This is Jigsaw. So we looked at this, and you can see here all these numbers here and all these numbers here are orders waiting to be executed. Yeah. Bookmap and Jigsaw will show you a heat map of where they are and a color scheme which shows you there's more here than there isn't. The problem with this is 90% of these aren't real. They're spoofed, what's called a spoofed order, which is basically institutions and banks place them in the market to entice price to a level where it can fill an order. When it gets there, they pull the order, meaning that all the volume that comes into that level suddenly hasn't got the other side of the order to take, which creates slippage and gets filled at a higher price. So what the banks and institutions do, which is frowned upon, is they spoof a level, wait for price to get to it, and as soon as it gets to it, they remove the order, flip long, put their order onto the other side and take a long, driving price up and completing the order and making profit, all done by algorithms. So while this, in theory, looks great, and you'll go, oh, and I did, oh, I found the holy grail of trading prop in futures. You realize that when you get to these levels, they vanish. Because it's not real. So, yeah, there's a million ways to use this as well. And again, if you use it and you find it works for you, and suddenly you go, oh, yeah, I've started trading this heat map thing, and for some reason it's clicking. Don't ask why. Do it. If it clicks, do it. It's going to cost you a couple of grand, and it's going to cost you 6 to 8 weeks of education, another 3 to 6 months of trying to make it work, and then it might click with you. And if it does, brilliant, do it. But at the end of the day, what you see here, okay, is exactly the same as what you see here. Yeah. Order flow. At this level, and there wouldn't be this because you can't trade pound US dollar on futures, but the pound futures market or the US futures market, at this level, you'd have seen a whacking great line in Bookmap saying, hey guys, there's a whacking great load of orders here. Oh, brilliant. What I'll do is I'll get in long with them. So when they trigger, I'll go with them. Or if you're short, you'll go, I'll get out down here because it's going to bounce. When it gets there, they pull the lot, flip short, and you get a propulsion gap. Why do you get a propulsion gap? Because the volume of short orders is now twice as big as it was when you thought it was going to be when you got there. And we slip down to here. And then we push back up and you go, no, I'm short, I'm adding more. It's the same concept, the same theory. But you're seeing anticipated future orders in the futures market. If they're real, it'll bounce. If they're not, it won't. What does it give you? A probability of what? Buy or sell. So it's just another way of picking a level to press a button at. What happens after the button press is how you make the money, not the button press. So Bookmap shows you lines where you can say, I'm going to get in long on this whacking great order the banks have got here. When it gets there, it will do that or that. And the words, you know, the thing that wound me up the most about this was knowing what I know about the markets and how they work, used to target these as my targets. So I didn't use them to get in, I used them to get out. So if I got into a trade and the trade was worked, I would stay in the trade until there, because these act like magnets in the same way as propulsion gaps. Yeah, these act like magnets. This is why these are all grey. Price comes back to these all the time. But you can't tell when, which is why I position trade, because I know it will come back to them at some point, but I don't know when. So what's the point in getting out? I'll just wait. That's why I make money. But I used to use these as targets. And do you know what used to wind me up the most? It would hit it and do that. Boom. because they pull the lot. And I would get out there with $600 and it would go $1,500 in my direction. It was more annoying the fact that they pulled the orders when you got a trade that worked than it was when you got stopped out on a short, because you put your stop above the liquidity, because if it's going to hold, it won't get through it. That's the theory. It's exactly the same theory as we've got with Harold right now and his strategy. You know, nothing wrong with the strategy. We've got a propulsion gap. We go short. We put a stop above the high, because if the theory is correct and the volume of orders there will be added to, it won't get through it. It does work sometimes. But Bootmap is basically full of lie orders. These are executed in the market, have been done orders. So as far as I'm concerned, these are much more Holy Grail-like than something that might happen, because these have happened. The reason that gap is there is not because something might happen, it's because that happened. Much more reliable. Yeah. Yeah, these are just so much better. Look, boy. So we got down to this level, we bought it. Yeah, we bought it again, we bought it again, we bought it again, we bought it again. We got overrun. We got exhausted because the amount of money it took to get through that level that they've been buying for a day and a half exhausted the market. So it bounced back. Where's it going to go next? I don't know. But probably there. Why? Because that's what happens. That's just what happens. I'm doing tomorrow's lesson. I remember you talking about spoofing. I don't think I'll be using heat maps. I'm an advocate for trying stuff. I've tried stuff all my life. All I will ever give you is my opinion on it. Now, because it didn't work for me doesn't mean it's right. Yeah, there's a lot of people that make money trading stocks. One of my mentors, one of the best guys I've seen trade, is a stock trader. I'm not very good at it. Yeah. It drives me nuts. There's too many stocks, there's too many options, there's too much going on. I like forex, I like position trading because it's simple, it's slow, and it's consistent for me. Other people do position trading and they go, I just blow my account. Why did you blow my account? Well, I don't know. And they just panic, and you know, it's just not for them. Then they'll go and scalp the 1 minute time frame and make a fortune. I can't do that either. I can, but it drives me mad. So go and try things, but understand the barrier to trying everything is monetary. Yeah. So if you go and try Bootmap or Jigsaw, and I would advise you to go Jigsaw rather than Bootmap. If you go Jigsaw, I've got an affiliate link for it somewhere as well. If you go Jigsaw route, it's going to cost, I don't know what it costs. I can't remember. I think it's a couple of grand I paid. And you can download a demo as well. Yeah, so I've got the institutional package, 2 grand. Yeah, which also gives me access to a trading course. So scrap that. The course is shite. Don't get the course. Go that. Yeah. You don't get the order flow training pack. It's on YouTube for free. You don't get the institutional training. It's just another strategy to press a button. To be honest, I don't think it really works. But and the monthly group therapy sessions are to help you get over the fact that you're getting it wrong all the time. That's why they call it therapy, not training. It'll drive you mad. I've never noticed that before. That's a really bad... Coming from a marketing background 25 years ago, calling something that is helping people group therapy. Support would be a better word to use, Jigsaw. I might email Dave. I can't remember the name of the guy. Is it Dave? I don't think it is Dave, actually. I think it's... I can't remember his name. Martin, I want to say for some reason. But yeah, change that from therapy to support. But yeah, it's up to you. Try it out. See what it does. Understand it's a rabbit hole that may suck you in for a while. Yeah. If you just use the position trader EA and let it get you in when you pick a criteria and wait, you'll have much more success. Except you will need a bigger balance to trade that way. Pros and cons all the time. Right, I'll leave it there. It's nearly 11 o'clock. Anything else you need, obviously, Discord or comments if you're watching on replay. I'll I've made a note of doing a broker session, doing a live price action trading session. Tomorrow, I will try and get the identifying good trading levels and targets and exits for price action in the same session so that we've got that wrapped up. And then Friday, maybe we'll spend just strategy development and back testing and price action trading. Yeah, so that will wrap the week up nicely if we actually do the price action trading live. And I might just, I've got an account with £1,000 or so in it, which I muck about with. I might just use that account. That's the one I used yesterday. Made 300 quid on it. I think it was £300. It's that one. Yes, it's this one because I got stocks on it. Yeah, £303 I made yesterday on this account. I only took 3 trades, 3 winners. All just literally, I was just redoing those exercises to reconfirm how to do them. So maybe I'll use this account and we'll just chuck the DAX up and go on the 5-minute time frame and just do some price action. Good idea. Right, I'll be back tomorrow morning, and as I say, tomorrow morning's members one, we'll try and get as much of that done as we can. And this afternoon, I'm going to spend a little bit more time on Harold's strategy with the propulsion and see if I can find some edges that we can properly back test. So I'm going to do some robustness testing on that this afternoon, and some index testing. And I'm also going to try and knock up a very quick EA to test the buy on Monday, sell on Wednesday index strategy that Alexander put in the group. So if you've got any others, obviously let me know. But all right, so anything else you need, let me know in Discord. Other than that, I will see you next time, guys. Have a good day.